So does the recent sell-off in AI-related names present an opportunity to get back into the growth trade or a sign of elevated market risk? Joining us now is Lori Calvasina from RBC Capital Markets. Lori, good to see you.
Good to see you, too.
Earnings in broad terms are doing their part in the AI trade and elsewhere. Markets not really sure what to make of the path from here. So what do you think is most salient?
So, look, I would say in the very short term, it feels like the rotation story is kind of on the back burner. It feels like we're starting to see more evidence of a reason to de-risk, and I see that in earnings revision trends, and I'm also seeing that in flow data. So on the earnings side, the rate of upward revisions, a good gauge of earnings sentiment, we're still seeing upgrades, right? Numbers are still going up, but they're coming in at a slower pace. That is true for S&P and Russell 2000, top 10 market cap names in the S&P, everything else, AI, everything else. It's not one or the other. And that kind of softening in general, I think, is kind of putting a dampener on otherwise good numbers. The quarterly growth rate is up to 27%. That's not quite as good as 1Q, but it's still up from 23 where we started out. Now, if I put that aside, one thing I've noticed that's really curious in flows data, if I look back like 3 to 4 weeks and I think about, writing my weekly and what we were seeing in the numbers, you were seeing some evidence of rotation, right? I think there was one like nasty out week and tech outflows, growth was softening, value was getting better. Well, guess what? Tech has bounced back now, but is not quite as positive as it was. So we can kind of put that to the side. Growth and value are both seeing outflows, and overall blend flows in the U.S. are starting to really kind of decelerate, and overall U.S. equity flows have had a couple of weeks of outflows recently. So I think that we're sort of seeing a softening that's permeating everything. What do we blame that on? I blame that on what's been going on with the Iran war. We've been pricing in de-escalation since March 30th. It's getting harder and harder to sort of argue that's the path we're on. But also, we've got the Fed meeting later this week. And, I've come to describe it as any time you put hikes out in front of the macro community, it's like you're squeezing their head in a vice. And they're going to find something to get worried about. And I think that's where some of these kind of existential AI issues are coming into play, frankly.
A bigger picture, though, Lori, like putting that all into a blender, how should you position yourself? Because it sounds like you're saying that overall we look like we're in a sort of a softening environment, but the tech trade, relatively speaking, will still be stronger.
So, I think that the de-escalation narrative favored rotation, right? Mm-hmm. And when that got put on hold, we started to see the market churn a little bit. And one way we can look at rotation is U.S. versus non-U.S. So U.S. outperformed initially during the war, then we got some de-escalation, U.S. lagged, and now it's just moving sideways. My weekly has gotten kind of boring when we're writing that page because it just keeps kind of churning to the side. If you think about, kind of short-term and long-term, I think short-term, be selective on both sides. That's what we wrote in our weekly this morning. The financials numbers look good. The industrials, they're expensive. I don't love them here. We're neutral. But, the earnings are coming through and the tone sounds pretty good. I do think the semis earnings revisions have stayed very strong. Valuations are back down to average. I think there's value longer term there. But, of course, we're just, as you mentioned at the top of the show, Mike, this tech trade is just churning within itself day by day.
And now you still have a 12-month target up about 10% for the S&P 500. Yeah. But I guess the question is whether we're going to need a little more of a reset lower to kind of get us working higher again.
Yeah, we've always said that 8150, that's the latest number. We update this once a month. It's a 12-month bogey. We have never said it was going to be linear. We have expected pullbacks to remain in the 5 to 10% range, which is what we call tier one of our tiers of fear. Basically, if you're not worried about recession or a major interest rate shock like 21-22, it's probably not going to be any worse than something like a 10% drawdown. So that's our, frankly, if that were to come in, that wouldn't rattle us in regards to the longer term target. I do think, with semis, valuations at average were good enough last year for the capital markets trade when all the private credit fears were escalating. We went from kind of crazy valuations down to average valuations. I think they're trying to make a stand in here, but we'll have to see.
In terms of the rest of it, it's a big week for earnings ahead, and we've already seen some outsized reactions to, Alphabet last week, IBM also. So what do you glean from that?
So, look, I think that, the hyperscalers are trying to thread a needle, and they clearly haven't threaded it so far. When I look at sort of the top 10 market cap names, which is where a lot of those companies are sitting, the valuations are off peak, but they're not washed out. So I can see the case for needing to take those down a little bit more. Look, I think we've had a very lumpy reporting season, right? And this next couple weeks is when it gets really busy. My team and I have our kind of war plans ready for how we're going to attack the reading this week. But I think we have to look at overall tone. And frankly, the stats have been mixed so far. You're seeing an upward tick in earnings beats. The revenue beats haven't been coming through. I think also companies have not been doing a good job, frankly, and the sell-side community has not been doing a good job of pressing them on issues like the Iran war. For example, if we looked at the last reporting season, companies were like, oh, we've got these inventories, we've got these hedges, we think it's going to go through the summer or 2Q. Well, guess what, guys? Now it's here. Tell us what your plan is now. And I was really alarmed, Melissa, like when I looked through some of the commentary last week, the industrials just really weren't giving us updates. And the analyst community was not pushing the companies on this. Now, we got a few bits of color here and there. But frankly, if we're going to calm this market down, we need the corporate C-suite to sort of step up here.